It's 6 o'clock in London, 1 p.m. in New York, 1 a.m. in Hong Kong, 3 a.m. in Sydney, 10 a.m. in San Francisco, and 10:30 at night in Mumbai. Greetings, good morning, good afternoon, or good evening, depending on where you are in the world today. My name is Patrick L. Young. The IPO-VID live stream Series 6, Episode 4 goes live. And to begin episode 34, the Shanghai Stock Exchange have taken the global crown in IPOs. That trumpeted a headline in China Daily's US edition this week, with the Shanghai Stock Exchange being given the world's most IPOs in 2020 title by the Chinese media outlet The Paper. That said, perhaps Shanghai somehow or other won on a technicality, because with 233 IPOs, it was a sensational year, but it clearly wasn't a knockout. Take NASDAQ, for instance. They welcomed 300 new listings. And then there was that flurry of SPAC and DPO business too. Then again, when it comes to less liquid offerings, plaudits to the Channel Island-based TISE, the International Stock Exchange, the group which brought some 831 new, less liquid instruments to market during 2020. Gosh, ladies and gentlemen, could we be facing an instance of fake news from China? Surely not. In crypto news this week, the week was, well, one of ransomware or possibly ransom whoops. The US feds are to be applauded for regaining most 63.7 out of 75 Bitcoin, which were paid to the Colonial Pipeline hackers. The frustrating part is that Colonial paid $4.4 million just a few weeks ago and have only got $2.3 million back, and that actually might be a high valuation given the current frothy market in Bitcoin. However, the key aspect is demonstrating how electronic money can run, and it can hide, but only for a bit, ladies and gentlemen, for when it breaks cover, it's likely to be caught. Something that was not so easy back in the old days of bank robbery when we were looking at old-fashioned numbered used bills. In other news, Jeff Bezos is headed into space. Presumably it helps his tax return to spend a day or two in orbit. Certainly, this week's G7 finance ministers meeting seemed to be decided by folks who find commercial competition an alien construct. All this and more has already been covered in greater detail in Exchange Invest Daily, the unique newsletter of the board's business. Send us an email or hit me up, Patrick L. Young, on social media, whichever stream you're watching us on, and we can get you signed up to understand the exchange of business in greater detail. And don't forget, ladies and gentlemen, throughout the course of this show, we would appreciate your love. Send us a little love, please, if you can. Like this on social media, and therefore help our wondrous guests rocket up the search engine optimization so that the AI bots realize what a good show we're having. Because today, ladies and gentlemen, well, we happen to be at this juncture. I'm in Gozo in the north end of the Republic of Malta, and my guest happens to be, I think, well, I'll get to that in just a moment, but I don't believe he's in New York. But the thoughts are coming from the heart of Wall Street. Our guest today is Kenny Polcari. Kenny's been an established New York Stock Exchange floor member for over 30 years. He's appeared from Wall Street across the TV screens of not just the United States of America, but across the world for many years. As managing partner of Kace Capital Advisory, Kenny serves wealth managers, incumbent broker-dealers, and emerging fintech companies alongside his Chief Market Strategist role at billion-dollar boutique wealth advisory, Slatestone Wealth. Earlier in his career, Kenny built the US equities business for ICAP, having previously run Salomon Brothers NYSE division. Kenny was a New York Stock Exchange governor for over a decade. Kenny, welcome to the show. Welcome to IPO-VID Livestream. Where in the world are you today?
Well, I'm actually in Boca Raton, Florida, but and I've been here the last couple of years after I pivoted from New York, but I did spend 40 years at the 38. Let's round up, but 38 years at the New York Stock Exchange and 35 of those as a member of the New York Stock Exchange.
Wow, absolutely incredible. 35 years as a member of the New York Stock Exchange. That's incredible. So, ladies and gentlemen, we're going to be discussing, well, some thoughts from the heart of Wall Street, which have been entertainingly and interestingly given to us by, well, the new diaspora of financial markets. It seems to be everybody's in Florida these days, Kenny. It's been a huge outpouring of people in the COVID times to the slightly more southern, balmier, and one might add, lower tax state of Florida.
Absolutely. And it's been, a result of what we've all lived through in this past year. It's given people a reason to reconsider kind of where they want to be, how they want to work, where they want to live. And certainly technology has provided everyone with the ability to work from somewhere else, right? You don't necessarily have to work in an office anymore. Even the New York Stock Exchange, which ended up closing down for 8 weeks during the beginning of the crisis last year. I think it closed from the end of March until the end of May. Functioned fine, right? Stocks in this country traded fine because of the technology and the market structure that exists today versus what was. But we can talk about that as we move along.
Yeah, absolutely. It's a fascinating topic. And ladies and gentlemen, if you want to interrupt us with a question for Kenny Polcari this evening, we'll be delighted to receive it, whatever social media stream you're watching us on. So Kenny, tell us, 38 years ago, you got into Wall Street. You must have been a babe in arms.
The summer of 1980 was the first experience I had there. It was the summer after my freshman year in college. I had the opportunity to go work as an intern on the floor of the New York Stock Exchange. Look, I wasn't from New York. I was born and brought up in Boston. I spent I grew up just outside of Boston, and I spent summers on Cape Cod. And I had not been to New York. I had no reason why. I had no understanding why anyone would want to go to New York City in the summertime. As a kid, I was 19 years old. I thought, okay, I'm going back to Cape Cod. I'm going to be a lifeguard on the beach. But that's not the way it worked out. And quite honestly, it's amazing. The story's kind of amazing because my first reaction to that internship opportunity was I scratched my head. Like, first of all, I didn't know what the New York Stock Exchange was. I didn't know stock from a bond, to buy from, sell an eighth from a quarter. It was not the world I was in. I was going to school in Washington, D.C., expecting to be, a lawyer and a politician and maybe one day president of the United States, which thank God that didn't happen. But then I had the opportunity to go work, like I said, as an intern one summer. And I thought to myself, okay, what's the worst that's going to happen? I'm going to go there. I'm going to have this opportunity. I'm either going to like it or I'm going to hate it. And if I hate it, I chalk it up, put it on my resume, chalk it up as experience. And if I love it, who knows, could change the course of my life. Well, clearly it changed the course of my life.
Changed the course of your life. And actually, summer 1980, the stock market was just about to change a lot of people's lives, wasn't it?
It was. The summer of 1980, for those of you who are listening to this who are not of our generation, what you have to understand in 1980 is we had just come through the Jimmy Carter presidency. It was the Iranian hostage crisis in this country. It was the oil embargo that had taken place in the late 70s. It was a horrendous economic environment. Interest rates were on their way to approaching 21% by the summer 1982. Inflation was running on its way to run to 10%, and unemployment was on its way to 13%. Ronald Reagan, the 1980 election had just happened. Ronald Reagan was the new incoming president. And so there was a lot going on, right? The Dow was trading in the 800s. Today it's trading at 34,000, but then it was trading in the 800s, and we might have been doing 25 or 30 million shares a day versus today we'll do 25 or 30 million shares in about 3 minutes, right? Average daily volume today at the exchanges is, totals about 12 billion shares a day. Certainly all that the result of technology. But then that's what it was like. But I have to tell you, it was the most amazing place in the world.
So at that time, I mean, it was an amazing place in the world. Certainly, I can remember being on the floor of the Life Exchange in London much later than that, in the late 1980s. But I mean, 1980, the New York Stock Exchange, I suppose that's really just like the peak of the floor, is it not? Or maybe that came a few years later.
I missed, you went in and out on me there. I didn't actually hear the question you asked.
That's all right. No, the peak of the New York Stock Exchange floor. I mean, you were on the floor with what, several thousand people at that stage?
So actually the peak, I would say, was, in the 80s and into 2000. It was the birth of the bull market. Now there were 5,000 type A personalities that worked on the floor of the New York Stock Exchange, which is what gave it its personality, which is what gave it its excitement. I mean, imagine 5,000 type A people in one kind of contained space, and think about the energy and the vibrancy in the room. And because if you didn't have a type A personality certainly the floor of the exchange was not going to be a place where you found success because it was overwhelming. If you were a type B, not really the place you wanted to be. But in the summer of 1980, like I said, we had just, Ronald Reagan had just stepped into the presidency, or was actually it was the summer of 1981. He had just stepped into the presidency, but as we were in that presidential election cycle and the U.S. economy was just a disaster and stocks were just, like I said, waffling around in the 800s, not doing a whole bunch of anything. But it was the country was getting ready, and the birth of the greatest bull market we had ever known was just starting to, incubate, because it was after Ronald Reagan became president in January of 81. It was after they instituted the Reagan tax reform package. And Paul Volcker, who was Fed chair at the time, decided that they were going to break the back of inflation. They were going to break the back of unemployment. They were going to break the back of money being just sitting in the banks. Because think about this for a minute. If you were anybody in 1981 or 1982 that had any money at all, and you could take your money and you could put it in stocks, and you could go out and buy Johnson & Johnson or General Electric or IBM, which are fine American companies, don't get me wrong. But you could put your money there, or you could walk down the street, knock on the door at, Citibank or Bank of America or Bank of New York or Chase, whatever, any one of those banks, and walk in and say to the banker, here's my money. I want to put it in a CD that was going to earn you 20% guaranteed, sleep at night, no worries, no nothing, 20% guaranteed, versus buying stocks, which have all the risk in the world. There's certainly no guarantee of anything. There's not any guarantee you're going to make money. There's not any guarantee you're going to lose money, versus going to the bank and putting your money in a CD and getting paid 21% just to have your money sit in the bank. And that's exactly what was happening in 81 and 82. And so I went back to I was there for the summer of 1980. I went back to college, where I immediately changed my whole focus on where I wanted to be, what I was going to study, where I found exactly what I wanted at 19 years old. So I went back in the summer of 81, and then I went back to college. I went back in the summer of 82, and this is where it gets really exciting, because now Ronald Reagan was fully in the presidency. Paul Volcker was at the Fed, and it was August. It was Tuesday, August 17th, and I'll never forget this day because it was like it was yesterday. And I can still, as I tell this story, I can feel the energy that happened that day. But on Monday afternoon, there was word spreading around the industry that the Fed was going to come out on Tuesday morning and make a surprise announcement. Now, remember, 1982, there's no internet, there's no computers, there's no radio on the floor, there's no television on the floor, there's no LinkedIn, there's no Twitter, there's no Facebook, none of it, right? And so the only way that news traveled on the floor was when one of the phones rang on the outside, and you picked up and you spoke to somebody who told you what happened. Other than that, you were reading the newspaper. But remember what the newspaper was. The newspaper wasn't a live, up-to-the-minute reveal of what was happening. The newspaper is what happened yesterday, right? But that's really how the world worked, right? We all understand that. Maybe the millennials today won't understand that, but in fact, that's how the world worked. And when the rumor came out during the day on Monday that the Fed was going to come out on Tuesday morning and make the surprise announcement, everybody almost laughed it off, because the Fed never, ever did such a thing, right? The Fed used to come out on Thursday mornings at 8:30. They'd open the door. They'd step out to the podium. They'd make this announcement. Here's what we're doing. They'd close their notebook, and they'd turn around. They'd walk out. They'd close the door behind them. They didn't stop. They didn't take questions. They didn't give you a Xanax and tell you, come lie down on the couch and let's talk about this and let's make sure you're okay with this. None of that baloney. The Fed came out. They made a statement. It was up to the markets to figure it out and understand what the thinking was, and so therefore the markets would do their work and then interpret what the Fed was going to do, what interest rates were going to do, and then what proper valuations for the market and for stocks were. Well, on this Monday, the 16th of April, the rumor was that the Fed was going to go out Tuesday morning, and everyone kind of laughed it off because the Fed never did that. So Tuesday morning comes, and we get to work, and the market opened at 9:30. But by about 8:30, everyone's on the floor getting the specialists are getting their books ready, and the brokers, like I was, getting their day ready, getting their pads ready, getting all the work from yesterday sorted, and all that stuff. But as the clock approached 8:30, it was a very interesting, and I'll never forget this. As the clock approached 8:30, there was kind of this hush. Now, remember, you can't really hush 5,000 people, but you could go from up here to kind of down here, as people were just kind of curious. And the only way we were going to find out if there was, in fact, an announcement, because remember, there's no TVs, no internet, was if the phone rang and somebody on the outside said, oh, by the way, this just happened. Well, it was about 8:30 and maybe 30 seconds. Every single phone on the floor lit up. And every single phone, you have to understand what they were. They were these big metal institutional phones, right? With the push button, 6 buttons on each side. So potentially 12 lines coming in. And in my spot, which was just big enough for me to stand, so it was the width of my shoulders, and it was, I stood, there was no seats, and the counter was up here right by my chest, and I had a buy pad, a sell pad, a cancellation pad, and a report pad, and I had these two phones in front of me. Suddenly, every line lit up. And the phones rang with the ringing sound that they used to have versus today. They play songs and they play music. But then it was like, and every phone on the floor lit up at the same time. It was like Christmas. Is it just the sound of every phone? And when you picked up the phone, the person on the other end started screaming at you. Did you see it? Did you see it? No, I didn't see it. What the hell happened? And so they start to tell you that, in fact, they came out. Paul Volcker came out and announced that the Fed was now going to break the back of inflation, was going to break the back of unemployment, was going to drive money out of the banks and into the market. And how is he going to do that? He's going to do that by cutting interest rates. And so remember what I said. Interest rates were 21%. 21% for everybody out there today who thinks interest rates here are 0 to 0.25%, and they can never go up. Let me explain to you. They can go up, right? And they were up. They were 21%. Mortgages in 1982 were 17% to borrow 30-year money. Today, they're maybe 3%, and everyone's having a nervous breakdown because maybe they're going to go to 4%. So anyway, so he came out, Paul Volcker, and he made this announcement that the Fed was cutting interest rates by 10 percentage points. Now, understand something. 10% is 2 percentage points when they're 21%. So rates are going from 21% to 19%. That was a huge move. Now, 19% is still high. I get it. But he drew the line in the sand, and he made this commitment to the country and really to the world that rates were going to come down. And what was that going to do? That was going to force money out of the banks, right, out of your CD, and you were going to pile it into stocks, which is exactly what happened. And so on that day, the Dow was trading, listen to this, at 792 was where it had closed on Monday night. On Tuesday, when this news came out, every phone started to ring, and the orders that were coming in were buy 100,000 IBM, buy 200,000 General Electric, buy 100,000 Abbott Laboratory. I mean, it was just crazy. Colgate, Palmolive, and Procter & Gamble, Bristol Myers, Eli Lilly, all these names that you know. It was incredible. Now, it's a good thing I was, 20 years old, because I could stand there all day. I didn't have to run to the men's room and pee every half an hour like I do now at 60, right? But then I could just stand there in one spot. And I could spend all day. And in fact, I did. And I never moved. And the phones just didn't stop ringing. And so at the end of the day, the Dow was up 34 points. That 34 points, I know you're all laughing. 34 points, what's the big deal? 34 points represented 4.5%. That was a 4.5% move. All by hand. There was no technology. It was all phone in hand and pen and paper. And so 4.5% move was a massive move in the Dow. 38 points. And the volume, remember what I said, on Monday, the volume was maybe 30 million shares. Yeah. On Tuesday by 4 o'clock, the volume that day was 138 million. It was 4 times the average daily volume. And the market, the Dow had rallied 4.5%. That was the birth of the greatest bull market this country and this world has ever known. And that was the moment that it happened. And I can, as I tell this story, my back is sweating because I can feel, I remember exactly what it was like. I can feel the phones ringing. I can hear the people screaming in my ear as I tell the story. But it was the most amazing, it was one of the most amazing moments in my 40-year career.
So this incredible moment, because it really kicks off what was also happening at the same time in the UK, because they were going through their own attempt at financial liberalization under Margaret Thatcher. And then we get into this incredible roaring 1980s bull market. And I think you say it so well, the lack of technology is something that people don't think about. And yes, I mean, the Wall Street Journal or the New York Post that you read on the subway in the morning was a reflection of what had happened the previous day, and
Right.
pretty much what had happened the previous day until about 10 p.m. in the evening. I mean, if something major had happened in Japan at 2 o'clock in the morning, forget it. You weren't going to know about it until you maybe got to the floor and somebody rang you up and they said, oh, we might have read it on Reuters or something like that, where they were in their early stages of doing electronic newswires. It's quite incredible, ladies and gentlemen. I'm here talking about thoughts from the heart of Wall Street with Kenny Polcari. If you've got any questions or pointers you'd like to make from this interesting history lesson, then ping us a message on any of the social media that's accompanying this live stream on Facebook, LinkedIn, and YouTube. So, Kenny, that was the big kickoff. That was the point where Volcker created the massive bull market. And then we start going into, actually, so many things happened in the 1980s I can think of. And I'm thinking like the Plaza Accord in 1985, which reshaped the dollar and so on. What was it like to be part of that incredible 5,000 strong, predominantly male, and certainly 100% alpha environment, which was the floor?
Right. It was, like I said, it was the most amazing. It was the most amazing place to be. I would get up I would jump out of bed at 4 o'clock in the morning because I couldn't wait to get there. It was just another day of all this excitement, all this energy. I mean, imagine if you're sitting at a concert and you're up close to the stage, and those big, massive speakers that they have by the stage, and when they start playing, if you're close to the speaker, you can feel the vibration coming from the speaker, like it goes right through your body. That's what it was like every single day. And you know what? If the market was up, it was, you could feel it, right? That was the whole thing. You could feel if the market was, if it was a bullish day or a bearish day. Because if the market was down, you could feel the pressure, but the pressure was a different pressure than if the pressure with the market was up. It was really an amazing, skill that you would have. You could feel the way the market traded. Anyway, so the 80s were great. That was really the kickoff of the greatest bull market. And so the Dow went from 792 until we got to the summer of 1987. It was trading at about 2,800. It had this massive move over the period of 5 years. And then we all know what happened is the crash of 1987, which was Black Monday, the 19th, which was another incredible moment in history, and certainly an incredible moment in the history of my career, that I remember like it was yesterday. And I think what people have to understand, because again, still in 1987, there was still no technology, right? There was still no Twitter and Facebook and LinkedIn and any of that stuff. And so news moved around the world via the telephone and via newspapers, just the way it was. But as we came into the summer of 1987, the global economy, which had really surged, right? Europe surged, Asia surged, the U.S. economy was surging. But the global economy started to kind of stumble, right? It had kind of gotten tired and extended. And what you would start to see is you'd start to see parts of Europe were breaking down, and then they weren't. Then they'd rally a little bit. Then the U.S. was backing off, and then it would rally a bit. And the same thing was happening in Asia. But it was kind of a I want to say volatile, but it wasn't volatile like the volatility we have today by any stretch. But it took longer to happen, right? But what had also happened, and this is key to the story, because what people may or may not understand is what really lit the fire for the crash of 87 was this thing called portfolio insurance. And portfolio insurance was this insurance product. Yep. And just like any insurance product, you buy insurance to protect against a loss, right? Whether it's health insurance, life insurance, disability insurance, whatever it is. But these academics and engineers and quants, right? Quantitative analysts, which is becoming a new source of study at college, right? It was after my college experience. So I missed that whole quantitative analysis era. But these guys who were not business people, right? They weren't finance majors, they weren't economists, they were academics, they were engineers, they were math majors, and they designed this product, and it was called portfolio insurance. And what it was supposed to do, it ran on this big IBM mainframe computer, and it was supposed to represent the future. And look what we can do. And now this computer is going to analyze all this data, and the computer is going to protect you. Okay, sounds good. I mean, it was 1987. It sounds very, Very interesting. And what they did, though, was they went around and they said they were the only ones that had this product, right? And so they went around the country and the world, and they sold this insurance product. It was geared towards big institutions. It wasn't geared to the retail trader. It was geared towards big institutions that had these massive gains on their books in positions from 1982, 1987, because like I said, the Dow had gone from 892 to 2,800. So these massive gains. And so they sold this product to all these asset managers, hedge funds, mutual funds, pension plans, as a way to protect their portfolios. Okay, great. Sounds good. And in a rising market, when you never have to use the insurance, it's all good, right? Everyone pats themselves on the back and says, look at what a great job I did. Well, that is until it doesn't work. And what happened was, as the global economy started to stumble in the summer of 1987, they would take data, and they would take all the data. They would take economic data. They would take pricing data. They would take bond data, and they would feed all this data into this big IBM supercomputer that was supposed to analyze it and spit out an action on how to protect your portfolio. And it hadn't really gotten to a point yet where the computer actually spit out an action during the summer, right? The markets were just stumbling a little bit and made its way. And as we moved into the fall, the markets globally came under a little bit more pressure. And now we get into October. And September, October typically can be very volatile times in at least the U.S. market, but really in global markets. It's a seasonal thing for whatever reason, but typically it happens. But as we moved into October of 1987, the market started to come under a little bit more pressure. The data was getting a little bit weaker, not only in the U.S., but around the world. And so I'll never forget it because it was the Wednesday, Thursday, and Friday, October 14th, 15th, and 16th, leading into that weekend. And the U.S. market had come under pressure on Wednesday and closed on the low. And what you have to understand is when indexes close on the low of the day, they trade and then they trade down and they close on the low. It typically sets itself up for another test lower the next day. It's just the way it works, right? Is that they test it again to see if the buyers are really there or if anyone's going to defend the position. If they don't, they push it lower again. So on Thursday, the same thing happened. The market bounced a little bit, they pushed it lower, bounced a little bit, they pushed it lower, and it closed on the lows again on Thursday. And with every day, the volume kept picking up a little bit more volume, a little bit more volume. So on Friday, it was really kind of an ugly day. The markets kind of were weak all day. They kind of ticked down all day, and they closed on the lows again. Now, I went home on the Friday night. I was 26 years old. I had gotten married a year and a half before. My daughter had just been born in March. We just bought this 3-bedroom house in Tarrytown, New York, and your life was good. And I went home that Friday night and I said to my wife, I don't know, something doesn't feel right to me. Like something in my gut just says something doesn't feel right. But what did I know? I was 26. I had no clue at all. And so the weekend came and went, and it was, Halloween, and it was my daughter's first Halloween, and we did the whole pumpkin patch picking thing and carved the pumpkin and light it up and, all that stuff that you do. And then on Sunday night, I crawl into bed. Now, remember, just like you said at the beginning of this, Sunday night at 9 o'clock in New York is Monday morning, 9 o'clock in Asia, right? Because you guys are 12 hours ahead of us. And so therefore, when I'm going to bed, you're just getting up. And so what had happened over the weekend was these portfolio insurance guys had taken all this data that had happened during the week, all the pricing, all the macro data, all the economic data, anything they could find, and they punched it into the IBM computer. And on Sunday, the IBM computer spits out this action. And it was the first time that this portfolio insurance had actually gotten triggered because the data had become weak enough that suddenly the insurance product said, okay, here's what you have to do. Well, again, what I said, it's Sunday night, I'm going to sleep, but it's Monday morning in Asia. So who are the first people to get the message? Not the Americans, because our markets were closed, were the Asians, right? And that whole region of the world. And so they get a message, anyone who bought the product gets a message that in order to protect your portfolio, you need to raise cash. So you need to sell the equivalent of 2% and then put that cash aside and let the cash just sit aside. And once the turmoil's over, you put the cash back to work. And that was supposed to protect your portfolio. Okay, doesn't sound so bad. the Asian region got the message to sell 2% of their portfolio. Well, look, if you're somebody that manages 100 million versus someone else who manages $1 billion, your 2% is different from his 2%. It's still 2%, but it's just a much different number in terms of size of assets you have to raise. And so the Asian markets immediately started to come under pressure because everyone got a sell order. Nobody got a buy order. Everyone was told to sell, sell, sell. And so what was amazing about this to me, and you'll see it as the story unfolds, is that the human beings, whether they were in Asia, Europe, or in the US, acted like drones, right? They acted like they didn't have a brain in their head. It's like they took the brain out and put it over there and just did what they were told to do. Well, naturally, they did what they were told to do because this product was supposed to represent the future. Right? It was all about computing power and, oh, the computer's smarter than you, and the computer's not emotional, the computer doesn't. Just do what the computer says. And so in Asia, they did what the computer said. And so the markets in Asia came under pressure. And as they got worse, as the market sold off in Asia, what did the guys at Portfolio Insurance do? They realized now the market was getting weaker. They took the Asian data from the day on Monday. They fed it into the computer because who's next to trade? Well, the sun moves from Asia to Europe, right? So the Europeans are going to be the next ones to get hit with this wave. Well, now once the computer spit out the response after the Asian markets, what message do the Europeans get? The Europeans get a message that says you need to sell 3% of your portfolio just because the Asian markets have gotten so weak that the impression was it was going to be worse in Europe. And so the European markets. So do you see what happened? So now the European markets start to come under pressure. Now, 5 o'clock in the morning, my alarm clock goes off. I jump out of bed. I take a shower. I shave. I get dressed. I get in the car. I drive down to the train station. I get my cup of coffee, and I buy the Wall Street Journal. But what am I buying? I'm buying the Monday version of the Wall Street Journal, which is telling me what happened on Friday. Meanwhile, Monday's already passed in Europe, in Asia, and now it's already Monday morning in Europe, and the world is melting down. But the Wall Street Journal tells me, oh, the markets came under a little bit of pressure on Friday, blah, 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 telling me nothing about what happened. I had no clue what was about to hit the United States. And so I get on the train. I read the newspaper. I drink my coffee. I get to the floor of the exchange like I would every day at 7 o'clock. I go through my tickets from the day before, organize them, get them ready. Suddenly at 7 o'clock, the phone rings. Now, the phone never rang at 7 o'clock in the morning. Because if the phone rang at 7 o'clock in the morning, it was because somebody died. Because at 7 o'clock in the morning, there's nothing going on in the U.S. Markets aren't open, yet you can't do anything. There was no pre-market trading, any of that crap. And so when the phone rang at 7, you knew there was a problem, typically. So the phone rang, and it was a customer of mine who worked at First Boston. He's a very good guy. I love this guy. And actually, you can see this. Somebody made a parody, kind of a skit out of it on YouTube. You could actually see me telling this story in a cartoon version. The guy created this cartoon. It's very funny. But the phone rang from this trader at First Boston, and he said to me, "Hey, bro, do you have any idea what's going on?" And I go, "No, I'm not really sure what you mean by that because no, I read the paper. I didn't see anything other. Yeah, markets were weak on Friday. Well, I read the paper. The sun is out. The world's not imploding. There's not a war. I don't. What do you mean by do I know what's going on?" And he starts to tell me what had happened in Asia and what was happening in Europe because now the European markets were coming unglued. And what was about to happen in the United States because now we were the last market center to get the message. And guess what the guys with the portfolio insurance were doing when Europe was melting down? They were taking live data from Europe and they were feeding it back into the IBM system.
Again.
And the IBM system was now spitting out another message to the Americans, to the fund managers in America about what to do. And the message we got was you need to sell 5% of your portfolio. Now, do you understand how that, do you see what just happened around the world? And so it was a disaster. And so I'll never forget this, at about 7:30, the phone started to ring. Sell 50,000, sell 100,000, sell 200. Everybody had a sell order. Nobody had buy orders. Everybody had a sell order. So when you walked out to Coca-Cola or Johnson & Johnson or Eli Lilly or General Electric or Citibank or whatever you walked to, there were nothing but sellers. Because remember, it was all a human-based system. There were no computers. So brokers would meet out in the crowd. And when you walked out in the crowd, the specialists would say to you, okay, before the market opened, What do you got? I want to sell 50,000 Coke. I want to sell 100,000 Coke. I want to sell 200,000 Coke. These are what the orders were. And people wanted to just sell them. And you want to know why people wanted to sell them? Because the computer told the asset manager, sell the stock. Didn't say sell it at this price. Didn't pick prices. The computer did not pick prices. All it said was sell the stock and make sure you raise 5% cash. However you do it, just do it. And so this is what I mean, how crazy it was. It was like you took your brain out. Now, listen, I'm sitting there in the phone. I'm going, are you sure you want to do this? Because you're going to sell, this stock is going to open down 10 points. Are you sure this is what you want to do? And the person at the account would scream at you, do what I said, just sell the stock. Oh, okay, no problem. I'll sell the stock. And so you sell the stock. And now listen to this. Here's a perfect example, because people sold what they could. The computer didn't tell you what stocks to sell. The computer just said you have to raise cash. And so where would they go? The asset managers would sell what they could versus what they should have, because who the hell's going to buy Bank of Hawaii? Right? The thing didn't trade 50,000 shares a day. You're trying to raise cash. What are you going to try to sell Bank of Hawaii on a day when the market's imploding? No. So you're going to sell Johnson & Johnson. You're going to sell GE. You're going to sell Coca-Cola. Why? Because they're huge market capitalization stocks. And so it's supposedly easy to sell them. Well, just get a load of this. Johnson & Johnson closed on Friday night at $96 a share on Friday night. It closed at $45 on Monday night. It lost 50% of its value in 6.5 hours when the broader market was down 22.5%. But Johnson & Johnson was down 50% because it was exactly that, a large capitalization stock that you could potentially sell. They destroyed it. They destroyed JP Morgan. They destroyed GE. They destroyed IBM. They destroyed Honeywell. They destroyed it all. But because the computer just said, sell it, raise cash. We don't care what you sell. We don't care how you sell it. Just sell it so you raise 5% cash. It was a disaster by the time the bell rang. Stocks were trading, like I said, that Johnson & Johnson had a 50-point swing. I was selling stock in the morning at 92, and then I was selling it at 47, and then I was selling it again at 45. By the end of the day, you had to go around and confirm all these trades with the contra side to make sure that the person who bought them actually had the right full figure. You know what I mean? I sold them to you at 54, not 50, not 52, or 54 and 7/8, or 51 and 3/4, whatever it was. But you had to go around and confirm every trade. And oh my God, it was like I'm sweating just telling you that story, because it was, in retrospect now, it was an amazing moment in history. But when you were going through it, talk about holy shit. I was like, and again, I was 26 years old, so I had really nothing on the table to lose other than my house, right? Because I went home and I said to my wife, I think this is over. It's like I think this is over. Now, what did I know, right? But at the end of the day, guys who were my age then, who were 60 years old then, who worked their whole life, had all this money invested in the markets, right? Because that's what we did. And they watched their 401ks or their retirement plans just get decimated. And I'll never forget, they were walking around like the world had just ended. And for a moment, it actually felt that way. I mean, it was my God, it was the most incredible moment. It was the most incredible moment in history. It was. And then after that, in the days after, the market suffered. And look, there was all this conversation about should they shut the markets down. Dick Grasso, who was a president of the New York Stock Exchange at the time, there was a booth space on the floor that had like hotlines to every major investment bank, as well as hotline directly to the Fed. And so all day long, there was this conversation about what do we do? What do we do? What do we do? And they talked about, should we halt trading? But halting trading would have actually created more panic. And so they decided not to halt trading. It was really an incredible moment. I'll just never forget what that was like.
So it's quite unforgettable. And certainly, I mean, you really bring it to life, Kenny, which is quite incredible. And you've actually drawn in a series of questions. So we've got to jump into some of those. And I'm going to go to the most recent question first of all, because we've got David Fenn. Thank you, David. Good evening. Great to see you watching today. He's saying, well, the futures and options folks in Chicago were a little better prepared because long volatility positions had been put in place the previous week by more than a few.
And that might be true. I wasn't in Chicago. I didn't trade futures at the time. It was, so what David says may very well be true. All I know is that what ended up happening happened. We all know it, right? The U.S. market collapsed. It lost 22% of its value in 6.5 hours. It was very volatile in the days after, actually the months after, until it kind of repaired all that internal damage. But out of that event was then born a lot of the regulations that we have today in terms of circuit breakers and all that stuff that now protect, or at least attempt to protect the market. Won't protect the market from falling, but what it will protect the market from doing is falling at that rate, at that speed, without a hiccup, without a break, right? Because now if the market falls, if the S&P falls 7%, the market will automatically shut down. That's now the rule. That's the circuit breaker, because that will give everybody a chance to take a deep breath. The market will close for 1 hour. Everyone will get a chance to take a deep breath and say, what's going on here? Why is this meltdown happening? Now, listen, if the market reopens and it falls another 7%, which it could do, the market will close again for 2 hours to give people once again a chance to breathe. Remember, in 1987, there were no circuit breakers. So, in fact, the market just kept trading lower and lower and lower. So David may be right, but like I said, I was in New York, not Chicago, and I didn't trade volatility. I didn't trade options, and so I did a lot of the option layoff business in New York. But yeah, it was
interesting.
Disaster.
It's very interesting. Certainly, I mean, some of the extreme portfolio insurance stories from the time are incredible. I remember from the Singapore exchange, Cymex as it then was, which is the futures exchange. So memorably, portfolio insurance had driven that market down so far in the early minutes that actually the stock market, if I remember correctly, in Japan was effectively limit down. But the futures market at one point, it opened at something like 6,500 points. And I mean, that was at a huge discount. The stock market, the Japanese Nikkei 225 at that stage was over 20,000. And there were actually a series of local traders on the floor of the Cymex who just sat around and thought, this is absolutely insane. And they bought some contracts. By the end of the day, the thing was back up to 18,000, 20,000. And of course, as we know, the Japanese stock market, it managed to rub off, it went straight through the crash of 87 and started gaining quite quickly. Its denouement came a couple of years later. Right. Thank you very much, David Fenn. That's an absolutely terrific question. Thank you for joining the IPO-VID live stream. Ladies and gentlemen, we've got just under 20 minutes left to run today. We're talking to a Wall Street legend, and we're hearing some thoughts from the heart of Wall Street with Kenny Polcari. Get your questions in now. Any comments you'd like to make, such as those made by David Fenn. And let's go to a question we've got there from, good grief, Beata Young. Beata Young, lovely to see you on this show. So she's interested, representing women on IT as she does. When, Kenny, did technology first make an impact on your floor career?
That's such a great question. And I should say this as well, because you made the comment about women, and there were plenty of women on the floor. Women, though, were in roles. They weren't the members until the late 70s, early 80s, when women started to smash ahead on the ceiling and break through and then become members, of which my wife was one. So my wife was like number 12 or 13 in terms of members of the New York Stock Exchange. But yes, technology started to impact the floor. Well, it started in very small ways, right? Probably in the very late 80s, the early 90s, in terms of order delivery, right? Order flow was being delivered. You could send up to 300 shares of stock directly through a computer system that would get delivered directly to the special post, therefore bypassing the broker. But that started actually in the late 80s. I think it was after the crash, actually, that first started to come in. And everyone kind of played it off, not a big deal. 100 share orders, 200 share orders, not a big deal, not a big deal. But that was really the beginning. But when did it really start to make an impact was after the turn of the century, when we went through the turn of the century, Y2K, when the markets went into that big market modernization move, which went from fractional trading to decimalized trading. It's when we went to decimalized trading that suddenly technology started to make much more of an impact. So to answer your question, it first happened in the late 80s, but it didn't really impact me so much. But it did start to impact me the minute we started that, the 2000 era market modernization move to decimalization and then more automation is when it first started. And then it just got progressively better as we went through the years. But I'll tell you something, it was the events of 9/11 that brought this really into focus, because prior to 9/11, the technology that was designed and being used was all about delivery, order delivery to either the broker on the floor or through the DOT system to the specialist on the floor. It was about delivery, not about execution. The way we were using technology in this country in the financial markets was about efficiency, right? Which is typically how you use technology, right? To make something more efficient. How do I eliminate these 5 jobs and make this computer do the jobs of these 5 people, right? I could do that and become quote unquote more efficient. And that's what the markets had become, was efficiency in terms of order delivery. But the order execution part was still being done manually, because we were trading in fractions of a dollar. And so when you traded, an 1/8, a quarter, 3/8, 5 to go to 7/8, there were only 7 price points between every full figure. And each price point was 12.5 cent, was a 12.5 cent increment. And so therefore that was a natural control for the way the markets traded. The minute you went to decimalization, there are now 100 price points to trade, because there's from a penny to 99 cents. And so now there's 100 price points to trade, and that started to make it more volatile. But that's what allowed the decimalization, is what allowed the technology to flourish.
Fascinating. So that's what decimalization. I think that's a great answer to the question altogether. I'm sure we'll hear from Batty Young again. She's actually saying, greetings to your wife, Kenny Polcari. Kenny Polcari, well done for being a role model. Miss Polcari is a role model. You're saying she was like in the first 20 women floor traders, women members of the New York Stock Exchange. Fabulous to see altogether. And actually, we got a good question I saw just a moment ago from a Rom Beat as well. So how would you compare from one technology-driven market to another, the market in 2001 and say 2019?
Well, that's an interesting question, because the technology has changed so drastically, and the rule set has changed so drastically, that the markets in today, in 2019 or 2020, 2021, are vastly different than what they were in 01. First of all, there are more venues to trade in. There are now sub-decimalization, right? Because in 2001, it was just decimalization. And then sub-decimalization happened, and I'm going to say sub-decimalization happened in 2003, maybe. So sub-decimalization means they broke the penny to go out 4 decimal places, right? Because when first decimalization happened after the turn of the century, we just went out 2 cents, right? So it was a penny to 99 cents. You couldn't trade in between the penny. Then when sub-decimalization happened, there are now 1,000 price points to trade at. Between $20 and $21, there's 1,000 prices, because you start at 20 spot 0001, 0002, all the way up to 9999, right? So it's 1,000 price points. And so that then changed it again. And then as the technology developed, it just got more efficient. And so the trading today, if you want me to describe trading today is I have to tell you, quite honestly, it's boring. It's like you're going shopping online to Amazon. You take your mouse, you point and click, you click a couple of buttons, you send the order to execution, you sit there and wait. The computer does all the work, it updates you automatically. Honestly, it's boring today to do it. I'm not saying it's not important. It is. But back when it was open outcry, when there were 5,000 type A people on the floor, it was a much different market. But even in 2001, there was still open outcry. Right? Open outcry did not die until 2005, right around the time that they imposed Reg NMS and all that. That's when the technology started to overtake the human beings, and they eliminated the open outcry. So now I could get out on the floor today, and I could stand at Coca-Cola, and I could say, 20 for 100,000, and I could bid $20 for 100,000 shares all day long. I could jump up and down. I could do jumping jacks and bid for stock and never buy a share. Why? Because the computer doesn't know I'm there, right? The computer can't hear me. So unless I'm in the system, I'm not going to be able to buy or sell a share. And so that's what happened. So ultimately, by 2005, that automation had gotten so sophisticated that open outcry died a natural death. And so today we'll trade 12 billion shares, which is I say that it's like a crazy number, 12 billion shares. But today they'll trade 12 billion shares. And at 4 o'clock when the markets close, everybody's cleaned up. By 4:10, you're all cleaned up. I mean, listen, when we traded by hand 30 million shares, I would have been on the floor till 5:30, organizing my papers and writing the reports and making sure it was all done. Now you can trade 12 million shares and by 10 after 4, you're done. So we could spend the whole hour talking about that question. It's a great question, but it is a very different market today, even than it was in 2001. And 2001 was a very different market than it was in the 90s. But I think what people have to understand, and I don't know if you're going to get to this or I'll get to it after, is the role that 9/11 played, because that actually played a very, very significant role in the technology and how the technology would change the U.S. markets and really the global markets, but how the technology would specifically change the U.S. markets and then what that meant for the world. So I'll leave that there, and unless you want me to talk about that, or if you want to answer more questions.
No, I think it's a great moment actually to go to exactly where we're at with 9/11. What did that do? Because I mean, I will make a couple of observations to get you going. One of the observations was that fundamentally the early stage concept of disaster recovery completely failed, because you had a situation where you had actually the communications cables went underneath the World Trade Center building, and had the satellite links that were there to back up were on top of the World Trade Center building. And actually those sorts of issues, just in terms of infrastructure, caused huge problems, which have created a huge reworking of how people go about. And of course, the modern interweb thing, on which everybody's watching us this evening, where I'm with Ken Polcari, and we're talking all about the wonderful, thoughts of a Wall Street legend as we're looking from the heart of Wall Street. It certainly upended the infrastructure.
Kenny? Well, what it did, and you basically hit the nail on that, because what people did not understand, and that event changed the world for sure. Everybody saw that event happen, and I, like a lot of other people, lived it. My office was on the 55th floor of the second tower. The fact I'm even sitting here talking to you is a miracle, because I should be dead, and why I'm not's a whole nother conversation. But let's just get to what happened first. When the buildings got hit and ultimately collapsed, in fact, it destroyed all the communications, because all the cables that ran, that powered everything that happened at the New York Stock Exchange, the specialist computers, my computer, the telephone lines, everything ran through the belly of the Trade Center. So when the Trade Centers collapsed, all those wires got severed. Now, I don't think anybody necessarily knew that. Like, do I think that Al-Qaeda knew that? No, I don't think they knew that. But what I'm saying is, one of the unintended consequences of that event was when those centers collapsed, all those wires got severed. So the fact is, the New York Stock Exchange could no longer operate, and there was no backup plan, because who in their right mind could have envisioned that event happening? And so therefore, the United States was neutered. I mean, they cut us right off at the knees. Now, again, do I think they knew that was going to happen? I don't honestly think they knew that, but in fact, that was one of the consequences. And remember, in 2000, the rules set did not allow New York Stock Exchange stocks to trade on NASDAQ, nor did they allow NASDAQ stocks to trade on the New York Stock Exchange. And so therefore, there was no real backup plan. Now you say, yeah, but you could have changed that. You're right. Maybe we could have changed it in time. But what we did was what the country did immediately was to ship in computer guys and cable guys and telephone guys, and they brought them all downtown to the New York Stock Exchange, because they had to rewire every single computer at the New York Stock Exchange, had to get rewired, had to go around this disaster that had just happened 2.5 blocks away, right? Brought the city to its knees, and had to rewire to get the New York Stock Exchange up and running. Because here's the deal. Here's what happened, and here's what people have to understand. Remember what I said to you. Up until this point, we were using technology to create efficiency. We weren't using technology to create stability and or even security, which is really mind-boggling now that you think about it, right? It was all about efficiency. And so when that event happened and the New York Stock Exchange was neutered, it wasn't like you took out a sign and said, oh, by the way, the New York Stock Exchange can't operate. Because think about this for a minute. If you were somebody that had worked your whole life, you had a portfolio of stocks, whether you were in the United States, in Europe, or in Asia, you were invested in the U.S. markets, and here you worked your whole life, you had a $2 or $3 or $4 or $5 million portfolio listed in stocks, and now on Monday it's worth $5 million, and on Tuesday this event happens, and you call your broker and you say, sell my stocks. I want my money, because you're nervous. And the broker goes, I can't. I can't because the market's not open. So I cannot sell your stocks. Okay. So then on Wednesday, you call your broker and say, okay, sell them today. I can't because the stock exchange is not open. Then you start to get nervous. Now you're in America. You're here. You understand it. You're living it. But just think about yourself. If you were somebody in Asia, somebody in Europe that has assets in American stocks, you call your local brokers and you say, sell my American stocks. And your broker says, I can't do that because the country's shut down. The exchanges are not operating. Now you get nervous and Europeans get nervous. And you see what's happening now? There's this global fear that's starting to build about money and about people wanting their money in a time of crisis. And so it became clear that this was going to happen. And it certainly started to happen in the United States. People started to get very, very nervous and upset. And so we as an industry recognized right away that we had to get the New York Stock Exchange up and running, no matter how horrific this event was. And 2.5 blocks away was this disaster, and the smoke and the fire and the burning that took place at the Trade Center. It burned in the belly of the Trade Center for 3 months, and the odor, the smell, and I can't even I can smell it right now, but I can't even describe to you what it smells like because it's like the smell of death, but it's like everything you can imagine. It's people, it's buildings, it's furniture, it's rugs, it's asbestos, it's wires, it's plastic, it's everything, right? It was horrendous. But we had to rewire the building. And listen, think about this. This event happened on Tuesday. They worked, from Tuesday afternoon, Wednesday morning, say, all through the weekend. They worked in 6 days. They got the whole place rewired. Now, they put it together with spit and Band-Aids, don't get me wrong. It wasn't certainly stable by any stretch of the word. But think about this. You can't get Verizon to come to your house if you have a local internet problem in 6 days. Meanwhile, we got the whole place up and running in 6 days. So it speaks to the testament of America to get this place back up and running. And I'll never forget, we had to come down over the weekend on Saturday and Sunday, and we had to test our phones and our computers to make sure that they worked. And everybody had a single line. Like I had coming into my booth space, I had 24 lines, 24 different customers. Everyone had their own line. Now I had one single line to do business with. Everybody had to use the same one single line. It was a disaster. Yet the computer, the automation allowed for customers to send order flow down into my handheld computer. But it was a really tenuous time. But I'll say this: on the Monday morning when we showed up, because the market was going to open on Monday, September 17th, and the people who could come back came back. We lost only 3 people that worked on the exchange in that event, but there were a host of other people that just chose they weren't coming back. They weren't coming back to New York City. They weren't coming back to work. They just weren't coming back. But everyone who did come back showed up that day. And then they had the policemen and the firemen, and they had EMT workers, and they had the mayor, and they had Hillary Clinton, who was a senator, and Chuck Schumer was a senator, other government officials, and all these people came down to the floor of the exchange. And the other thing that they had was they had this woman she's in the Army, and she's a singer. She's in the Army, but she's also a singer. She's got this spectacular voice. And they shipped her in, and she stood up on the podium at the New York Stock Exchange at 9:15 in a cappella style, just belted out "God Bless America" before the market opened. And it was a moment in history like none other. You had all these people on the floor in this event that had just happened, in this heaviness that was just everywhere. And this woman is up there singing "God Bless America." So when you think about this poignant moment, and then she got done, and then the bell started to ring. And here was the other point: as the bell started to ring at 9:30, you could feel everybody in the room just go, "Ugh," and hold their breath, because when they flipped the switch, you had no idea if the computers were going to work, the order flow was going to start, stocks were going to trade, because it was all very automated at this point, right? You had no idea if it was going to work or if it wasn't going to work. And so there was this tension in the room. And when they flipped the switch, you could hear the hum of the computers, and suddenly you could see the ticker tape starting to move, and you could see stocks trading, and the market came under immediate pressure, which everyone expected it was going to do, because now everyone wanted their stock. Everyone wanted money. They didn't want to own a piece of paper that says I own Coca-Cola or Johnson & Johnson. You wanted your cash, so you called your broker, "Get me out." It was right. And so it did. So the market, the whole day, you're like walking on eggshells as you're waiting at any moment for a collapse or for a malfunction or for the market to just implode. I mean, it was the whole day. And by 4 o'clock, when the market did not, it closed down that day, we traded like 1.9 billion shares, which was a huge number then. And the market was down 600 points, 500 or 600 points, which was also a huge move by then. But I'll never forget this. At 4 o'clock in the afternoon, when the closing bell rang, it was the most unbelievable moment in the 40-year history, because it was at that moment. It was at that moment that everybody exhaled, because it was like you were holding your breath the whole day. And you were finally able to exhale. And it was at that moment that people started to hug each other. And it was like they opened the spigots. I mean, and you're talking about grown men, right? Hugging each other and tears in our eyes, thinking what the world and what we had just lived through, and really what the world was living through. And to think that here we were at the very core of what had happened, because look, it was an attack on America for sure. And when America stands, you know, the New York Stock Exchange is the symbol of freedom and capitalism around the world. And so to think that we came this close, because had they flown a plane into the building, they would have brought this country to its knees for a whole lot longer than 6 days. And it was at that moment that it became incredibly emotional. And then the rest from there, after that event, is what then caused the conversation about, okay, how do we now use technology, not only to create efficiency, but that was now third on the list. How are we going to create security and stability? That's really the role that technology needs to play now. And that is the role that technology plays. And so today, as a result of that event, and maybe it was going to happen anyway, but as a result of that event, and it lit the fire under its ass, is that today in this country, we've got 11 exchanges. The New York Stock Exchange is the only physical one. Everything else is electronic. So if they blow the New York Stock Exchange up tomorrow, is it a tragedy? It's an absolute tragedy. Absolutely. But they will no longer hold the country or the world hostage, because the other venues that exist, the other exchanges that exist, are all virtual. They trade in the cloud. You can't blow the cloud up. Now look at the servers that run that cloud. They're located all around the country. So it's in California, it's in Maine, it's in Florida, it's in Massachusetts, in New York, it's in Kansas. They'd have to blow up the whole country to bring those servers down. And if they do that, who really cares where Bank America is trading? Because we've got a whole different problem on our hand. And so that's how it's protected today. But that also then plays into that question that she asked about the role of technology, because today technology is so much more sophisticated and allows for so much more that it's so vastly a different place.
So therefore, technology has given us a totally different place. You've been through these incredible emotional stories from start to finish. Kenny, one last question. I'm really interested. The New York Stock Exchange that you joined was a members club with a barbers, with all sorts of wonderful function rooms for members, et cetera, et cetera. It really was the ultimate gentleman's club in Lower Manhattan, around the Wall Street area, surely, when you were there in 1980 as a young man. How do you feel about the New York Stock Exchange now, given the fact that obviously one thing we have in common is we're both alumni of the exclusive group of a few hundred people who've been inside the ice house, as they call it now, and on the New York Stock Exchange podcast. How do you view the way that the company, the corporate structure, has driven what was originally the club member exchange?
Listen, when it was the club member exchange, it was when it was still private, right? When it went public in 2006, when all the exchanges around the world started going public, is really when the whole culture changed. But look, the New York Stock Exchange continues to function as an exchange and will continue to survive and function as an exchange. It was forced, the same way the whole world, you and me, whatever, everyone's forced to change in this environment. And so the New York Stock Exchange has changed. Do I wish it was what it was? Of course I do, but that's me being selfish, right? I realize today it couldn't be what it was. I realize that. So what I have to say is that the exchange has been forced to reinvent itself, to kind of use technology to recreate itself, to remain relevant, and it has done an outstanding job doing that. Is it the same place it was? Of course not. Will the New York Stock Exchange as an institution continue to exist? Absolutely, but it will continue to evolve over time. It will get more and more automated, but that's that's not their fault. That's just the speed at which technology is revolutionizing the world. And so in order to remain relevant, they need to continue, like everybody, they need to continue to recreate, reinvent themselves. Listen, I love the New York Stock Exchange. I spent 40 years of my life there. I met my wife there. I mean, I had a life there. So for me, I bleed the blood of the institution. But and I'm sad I'm sad as I think about the memories of what it was versus what it is today. But what it is today is a very vibrant exchange that just uses technology to to service the world.
Using technology to service the world. An emotive and incredible 1 hour discussion we've had this evening, ladies and gentlemen, with Kenny Polcari. It's fascinating what Ken Polcari has been talking about, the whole history of his 38 years, nearly 40 years on Wall Street, within the New York Stock Exchange, building something that started as a mutualized entity, which was running on no technology whatsoever in a meaningful sense when he first arrived in 1980, and doing only volumes of a matter of a few, really handfuls of millions of stocks per day, the sort of things that it gets through now pretty much in a minute every day. The idea that you can see a marketplace in your career time going from 30 million shares traded a day to 12 billion in a day. The computerized messaging, which has come in on top, of course, as we know, is absolutely staggering. 80, 100 billion messages being taken across the course of those markets in the course of last year on days when there were particularly volatile days driven by COVID. It's been fascinating to hear about how Paul Volcker, of course, kick-started the incredible bull market that started in 1982 and genuinely revolutionized a new period of prosperity in the lives of America under President Reagan, something which I think a lot of people have forgotten about in the current modern age of 2021's COVID crisis world that we see around us. And one thing is clear, certainly, ladies and gentlemen, we share Kenny's incredible passion for markets, a passion for exchanges, and a belief that exchanges are at the epicenter of those markets. Kenny Polcari, thank you very, very much. It's been a joy to have you on this show. Following in Ken Polcari's footsteps next week is going to be another Wall Street legend. We're going to be looking forward to David Weil IV. He is the father, effectively, of crowdfunding. He's the man that made it all happen in the United States of America and many, many other things besides. Not at the huge top end of the stock market chain, but delivering liquidity, value, accessibility, and the opportunity to grow the American dream and to grow markets the world over. Ladies and gentlemen, my name is Patrick L. Young. Thank you very much once again, Ken Polcari, for joining us this evening. We've been hearing some great thoughts from the heart of Wall Street. I wish you all, ladies and gentlemen, a great week in life and markets. We'll be back, same time, same place, next Tuesday at 1 p.m. New York time.